Okay, well, then without further ado, has everyone here, kind of seen B.A. Harris's name around, okay. So Arla and Aaron are here from B.A. Harris, but I wasn't sure exactly how to introduce them because we all kind of already know you guys. So I just went to Google and I'm like, well, they've got 5 stars on Google, so obviously they're good. But yeah, Mike Swopes used B.A. Harris for a long time, and they're always very generous in sharing their information. And when I actually looked at your website, which I think is new, it looks good.
About 2 years.
Okay, yeah. I don't really have to go to your website. I just, but it gives a list of services. And so what's special about these guys, in my opinion, is that they're proactive and they will actually provide business consulting, tax consulting, and advice. It's not just autopilot tax prep. And if you start to get too inundated, they have bookkeeping services. So next year when you come, I can give you guys my feedback on that because I think that's where I'm heading. But yeah, I literally had a friend recently call me up and ask if I knew anyone, a really good friend from Oregon. And so they're not even limited to Idaho, apparently. So anyway, Arla and Aaron, welcome to Avid Investors.
Thank you.
As you know, this is your slide mover.
Okay,
And
thanks.
then hopefully they see it a little clearer, but we guys on Zoom, we can email you also the presentation if you need a copy of it, because I know it doesn't seem like it's very clear. Yeah. So
Oh, yeah, it's got a bit of a glare on it.
yeah.
Well, that was very nice. Thank you for that
You're
introduction.
welcome.
And we are a local firm that's been around 25 years now, so we do know a few people. And we've grown tremendously. So we do have an entire new accounting department too that provides the accounting and advisory services. Usually we come to this in every January, and we kind of give an update as to what's happened with federal tax law, changes to real estate taxation. And this year was the first year in several years that really federal law pretty much stayed the same. And so we don't have a ton of new stuff to talk to you about as far as that goes. And we're pretty grateful for that. But we do have some state changes too that came into effect last year. And so I'm going to let Aaron go ahead and take over there. And certainly if we don't cover anything you have questions on, just let us know at the end and we'll be happy to answer questions too.
You want to go first?
You want me to?
That's great. I think it's the
Okay.
first.
I think the very first slide we have on here is yeah, that's gonna be tough for people to see at home. The Foreign Investment in Real Property Tax Act. This is called FIRPTA. I don't know how many of you have even heard of it. I know that several people that I've talked to have never heard of it, and it affects real property investors in that if you're purchasing, and this is where it comes into play for most investors here in Idaho, if you're purchasing a piece of property that is sold by a non-US resident, as the buyer, you're actually responsible for withholding their income tax on the sale so that they can't just, as a foreign person, sell it and never pay the tax on it, and because they don't file a US return.
And that's only if it's purchased in the US.
In the US, yeah. This is just on the, they call inbound, but yes, so. I really just wanted people to be aware of it because we are seeing it a little more regularly than we did before, as there are more foreign investors coming into real property in the Western United States too. And we also have clients that are in Florida and we've seen it happen a few times there. But basically, at the closing, you will collect there's forms that need to be filled out, the forms 82, 88 that have to be filled out by the seller, the foreign person, and also by yourself and signed, and then the calculation of the tax. And so it's withheld at closing. Usually the title company is going to take care of most of it, but You just have to be aware that you're actually the ultimate person responsible for it. If you were to purchase a house from a foreign investor and the title company didn't know what they were doing, or you're trying to kind of do it outside of a title, or outside of not using realtors, or you may be stuck with that. You could be stuck with a tax due on that for somebody else's gain. So I just wanted to bring that up. And so if you ever are buying a property from a foreign investor, you wouldn't be surprised by that. And we're gonna let Aaron continue.
Thank you. Thank you, Stacy, for having us. I mean, I don't know how you guys can see that backboard. That is just absurd. So I'll definitely do my best to try to squint my way through this.
You can turn around too
Presentation.
if you
Yeah, I
want.
hope you don't, yeah. I hope
And the
people at
Zoom
home,
folks Your words will be the.
okay,
part.
hopefully they aren't offended by seeing my back for most of the presentation. Arla also wanted me to throw in a slide here showing for anyone who potentially is new, just some real estate rental deductions that we want people to be aware of. Code section 162 requires that expenses must be ordinary and necessary. This includes mortgage, interest, and property taxes. I feel like I'm just going to be end up reading right off of this slide here. I guess some things that we should point out, the meals are 100% deductible. Typically, they've been limited to 50%. This is for 2022. However, going forward to 2023, the meals deduction goes back to 50%. And those have to be business related meals. This isn't, I eat bacon and eggs at home, so writing that off. Entertainment as usual, non-deductible, and that's for both years. Mileage last year, hopefully everyone was taking good track and keeping logs of their mileage and the days that those were traveled, because the mileage rate changed last year because of the increase in gas prices. Changed in July from 58 cents from January through June to 62.5 cents from July through December. It's the first time the gas mileage rate has changed. I can't remember. Do you recall? It's been a long time since that's happened.
We're not fond of when it changes mid-year though, because most people don't cut off their mileage.
Sure. Yeah, it adds a little bit of extra work when we compare those tax rates as well. And then it goes up to 65.5 cents per mile in 2023. Just wanted to always throw that out there, that this has to be business related mileage. You traveling up to McCall to go water skiing, doing no rental activity while you're up in McCall is questionable. I would probably not want to be keeping track of those miles. Your cell phone, internet, and home office, we take the stance that that's fully deductible because you need your cell phone at all times. And you need internet service at all times in this day and age. So don't feel like you have to keep track of, well, I did 25 minutes of business related phone calls this month and out of 500 total mile of minutes. Don't stress about that. Just 100% deductible. And depreciation, there are also several accelerated methods available where we can fully depreciate certain things depending on the type of property that you own. Okay, so here's the reason, the big reason that we're here. So the state and local tax limitation workaround. So I'm not sure how many people are familiar with or who look very closely at their tax return. But in 2017, the Tax Cut and Jobs Act limited the deduction for state and local taxes on individual returns to $10,000. So that includes state taxes, local taxes, real property taxes, and personal property taxes. So it used to be prior to 2017 that if you were itemizing on, or on your Schedule A, there was no $10,000 limit. So people on people in the West Coast, specifically like California, or on coastal cities like New York, they have really high property taxes. So this is when the law came out limiting these to $10,000, it really hurt, because they're paying all this in real estate taxes. They get no benefit from it after they reach $10,000. So that also resulted in many taxpayers losing out on federal tax deduction that they had previously received, because they're now no longer itemizing. They just get the standard deduction. So is there a way around this limitation? Well, in November 2020, the IRS released notice 2020-75 that said state and local income taxes imposed on and paid by a partnership or an S corporation on its income are allowed as a deduction in computing federal AGI and thus are not limited by the SALT cap. So it's basically a workaround where these business entities, S corporations or partnerships, can pay the state tax generated by its income for its members. And that way the members of that partnership or S corporation are able to deduct that state tax that they owe through their business as opposed to being limited to the $10,000 on their individual return. It's hairy. Just let me try and explain. So on April 15th, 2021, Brad Little signed House Bill 317 into law, which allows the workaround in the state of Idaho. So the bill permits Idaho state taxes on Idaho sourced pass-through entity income to be paid at the entity level. It's basically saying, okay, this works in Idaho. Go ahead and make those deductions. So how does this workaround work in Idaho? I want to stress that this is in Idaho, because I will get to that later. This is not the way that technically it works in many other states, neighboring states at that. So basically the business entity will make an annual affected business entity election or an ABE election. And this needs to be made on a timely filed original return for the taxable year. And it's available only for S corporations, partnerships, LLCs, taxes, partnerships, trusts, and estates. So no C corporations and no sole prop LLCs. It can't be you cannot make an amended return to go back and make an ABE election. So if you already filed a partnership return or an S corporation return, and you're just now in an Avid meeting learning about it and saying, well, I want to go back and make that ABE election, the rule states that it has to be on a timely filed original return. So you can't go back, unfortunately, and amend your return to make an ABE payment. So once you filed that return, you're kind of stuck with it. A pass-through filing its first tax return can make an ABE election by September's extended due date, but it has to pay an 80% of its ABE payment by March 15th of that year. So let's say that you want to start a partnership with your rental property and you've never filed a partnership return before. And let's just say that your ABE deduction is going to be $10,000. You have to pay in at least $8,000, so 80% of your ABE deduction by March 15th if you want to extend that return. Because the way that it works is if you haven't made that 80% payment by March 15th, the state doesn't consider your extension valid. So you will not have made a valid extension and you will not have made an ABE payment on an originally filed return. So if that's the route you're thinking of taking, make sure you make that 80% payment. A pass-through that wishes to extend that has previously filed as an ABE must pay in at least 100% of its prior year liability or 80% of its current year liability. It's basically the same safe harbor that you have for your state individual returns, but because in the example above, you've never made an ABE payment, there is no 100% of the prior year liability, so you're stuck with the 80% rule of the current year. In Idaho, once the election is made, it's irrevocable for that tax year. I'm not sure exactly why you would want to revoke making an ABE election because it ultimately benefits you regardless, as long as you make it. You're going to have to pay that tax anyways. Basically, all that's happening in this scenario is your entity is paying the state tax that you're going to pay anyways. You just pay it a month early, and then you get a federal deduction. So I'm not sure why exactly anyone would make that election and then revoke it later, but you can't do it in Idaho anyway. So the entity electing ABE status will be responsible for paying the Idaho state tax, resulting in a deduction to its members' income tax at the federal level for the taxable year in which the tax payment was paid. So that makes tax planning critical if you want to receive the deduction in the current year. So basically, going back to our example where you have to make a $10,000 ABE payment, it's crucial that you know that that's what you estimate your ABE payment to be before year end. Because if you wait and you make that $10,000 ABE payment after year end, you don't get that $10,000 deduction until you file your 2023 taxes next year. So if you want to get the benefit of this ABE deduction in the current year, so let's just say in 2022, you will have had to have made that ABE payment prior to year end. So a little late to do anything about that now, but I have a slide that goes over what we can do there.
So, okay, so are you saying when you're gonna make sure, did you say you make sure you pay your extension so that and that's for your income taxes? Businesses taxes?
So what I'm saying in this scenario here is, let's just say that, it's getting to November or December, right? And you haven't made your ABE payment yet.
Well, is the ABE payment the property tax payment from the entity?
The ABE payment is so let's just say that your company, your rental is producing $100,000 in Idaho net income. That would be 6% of $100,000 is what that's gonna end up producing for you in state taxes.
Okay,
So you're gonna have a $6,000 ABE payment to make.
okay,
you-
so it's basically estimated taxes.
Exactly. So if
Okay.
you make that $6,000 payment prior to year end, you can deduct it for 2022. If you wait until after year end and then you finally, you just discover like, oh, I have a $6,000 ABE payment and you pay it in 2023, you'll get that deduction, but not until 2023. So if you want the benefit for as soon as possible, you want to pay it before year end. So if you wait and do your books after year end, make your ABE payment after year end, you don't get that deduction until 2023. So that's why tax planning is crucial. You want to get with your accountant and figure out exactly where your net income sits so you can make that deduction or you make that payment as soon as possible so you can get the benefit of the deduction now as opposed to next year.
And then you also said you had to make sure the payment was paid by the business account.
Yeah,
Tax payment.
it should be made through the business account from the business.
And that helps you avoid the $10,000 limit
Mhm.
on the property tax deduction.
So yeah, so that helps you. So if you were to pay that $6,000 personally, you'd be limited to $10,000. But since you're making it through your business, I mean, that can go up to, we have certain clients who have tens of thousands of dollars of state taxes that their business is generating. If they were to pay that personally on their 1040, they'd only get to deduct up to $10,000. But because they're making the ABE deduction election, they can pay it through their business entity and take that whole deduction on all the state taxes that it's generating.
And that
The way you're
$10,000
receiving the entire deduction is because on his example, like it's $100,000 worth of rental income. Normally, that's going to pass through to your individual return from a partnership. And this is only, like I said, these are from pass-through entities. So if you own the rental personally, you're already reporting it on your individual return. You can't do it that way. But if you're in an entity, so instead of $100,000 of income showing up on your individual return, it's going to be $94,000 of income. Because you get to deduct it at that entity level before the income ever comes onto your individual return.
And that's, so are we talking, sorry,
No,
Like-
please. I know it's confusing. It's tough to write these slides. I could only imagine. how
yeah,
tough it is
and
to
then there's,
understand.
so, this $10,000 this deduction, it's for the state proper, it's for our property taxes.
No, it's for the income taxes on your rental income.
Okay.
So
okay.
yes, but normally you're gonna get taxed on that on your 1040 because on your individual return, because it passes through from a partnership and just ends up on your individual return. So, and that's where that limitation is on the individual return. So if you pay it through the entity, instead of getting $100,000 of income to be taxed on, it's gonna be $94,000 of income because you've already paid 6 or 8, well, your example was actually, it was 6,000.
I think I have a case study here that hopefully clarifies this. And trust me, if your head is spinning, it's understandable. I mean, trying to make this understandable in a 20-minute conversation is tough. I mean, this is our job.
All I have to do though with all the real estate. Those four items like tax.
No, it's not.
All about both taxes being limited to $10,000.
Yeah, exactly.
All about that.
Yeah, it's a workaround. So instead of being limited to only deducting $10,000 worth of those, you can deduct all of the income that's being generated from your partnership or S corp. You can deduct it at that business entity level as opposed to being limited.
So if the private return only gets 10,000, But if you have one of these ABEs,
Mhm,
they can and qualify,
mhm,
then it takes all of the taxes.
mhm. Exactly, so
It could be a huge amount.
exactly, I mean, we do
Yeah.
this, if you notice, there's S corporations that are involved in there, I mean, we work with doctors who, are making millions of dollars and generating, tens of thousands, if not hundreds of thousands of dollars worth of state tax. Instead of that passing through to their 1040 and then paying it there and being stuck with only deducting $10,000, they can pay it through their S corporation, which holds their business practice, deduct all of it and really make a big dent in their tax liability. So hopefully this clears things up a little bit. So let's say in 2022, a married couple earns $150,000 in W-2 wages, so they're, you know, just working their normal 9 to 5s, and on the side, they also have $100,000 in rental income, which they report directly on their individual returns on their Schedule E, so no partnership. All of this $100,000 of rental income that they have is just being reported right on their Schedule E, no AB deduction, they're gonna pay the tax on their return. So between their state withholdings on their W-2s, so from their 9 to 5s, their employer is withholding state taxes and they're making those payments every paycheck. And the property taxes that they pay on their primary residence every year, they run up into that $10,000 SALT limitation. So you can only deduct that $10,000 up to $10,000. They receive no deduction for the $6,000 in state taxes that they will have to pay on their rental income. So their rental, you recall, is generating $100,000 in net rental income. Multiplied by the state income tax rate of 6%, they're going to owe $6,000 to pay the state from their rental activity. Since they've already reached that $10,000 SALT limitation, they're paying that $6,000 to the state for their rental income and getting no benefit whatsoever, because they can't deduct anything more than $10,000. So instead, let's say that this, instead of filing their rental income on their Schedule E, let's say that this couple instead files a partnership return for their rental properties, which are held in an LLC. This partnership then elects ABE status for their partnership on a timely filed return. And they make their $6,000 ABE payment prior to year end. So they were smart and did some tax planning, and they estimated that they were going to generate $100,000 in net income prior to year end, and they made their $6,000 ABE payment through their partnership to the state prior to year end. So now that $6,000 Idaho state tax generated by their rental can be deducted from their federal taxable income, which would save them $1,320. So instead of being limited to $10,000, which they were when they were filing this rental income straight on their Schedule E, they just file a partnership return, deduct all those taxes at the partnership level, and now they're not limited. That $6,000 is fully deductible, and they are able to save $1,320. So that's $6,000 times 22%, which would be their marginal rate. So that $1,320 is just straight tax savings that just they would not have access to had they filed their rental income directly on their 1040. So what can you still do for your 2022 tax year? So first off, I would always recommend that you analyze if the additional professional fees will outweigh the potential tax savings. We don't want people to hear this presentation and say, well, I'm going to go do that right now, and come to find out they're paying thousands of dollars in attorney and accounting fees to save $200. We don't want that to happen. So definitely take a look and see if the juice is really worth the squeeze. But if you have been filing a partnership return in the past, an ABE election can still be made. And posit, you would be surprised at how many business entity tax returns we're receiving from new clients. The first thing we do is look and see if they've been making ABE payments, and they're completely blank. I met with a new client a couple days ago who missed out on about $60,000 in tax savings because they weren't making their ABE payments. So this is still an issue. Even if you're working with an accountant, not everyone is super well versed in this stuff. So definitely something to be talking with your accountant about. So if you've been filing a partnership return in the past, an ABE election can still be made, but an ABE payments made as of 2023 will be deductible on next year's 2023 tax return. This is what I was talking about. you want to try and make those ABE payments prior to year end so they can be deducted on the current tax year's tax return as opposed to having to wait till 2023. If you're married with a rental held within an LLC, so there's a lot of hoops you kind of have to go through. That has its activity recorded on Schedule E, so that couple we were just talking about. You can still file a 2022 partnership return and make an ABE payment, which can be deductible in 2023. So not 2022, that couple would have lost out on that because they had never made their ABE payment in 2022. They're going to wait till 2023 in the situation. But you can still do it as long as you're married and you have your rental held in an LLC. You're going to need to apply for an EIN, which you can just do on the IRS website. And I think is it instant, Carla, or does it take a little bit?
It should be instant.
Yeah.
I mean, there's some certain hours that they're open, but other than that, yeah.
And if you're sitting at home right now and thinking, well, it seems like it's a lot easier to do this if you're married, that's absolutely correct. And this is one of those deals. For single filers, it is possible to do this. Arlo and I were discussing this prior to giving this little talk. You could set up an S corporation, and that S corporation could be your partner in your partnership, but that creates a lot of hoops that you have to jump through that we think for most people is not going to be worth it. But
What about the trust?
Yeah,
Well, you could do that too. You could have a trust as one of your partners, and then that's why it's easy for a married couple to do it, because generally a married couple is a single member LLC in the state of Idaho, but by filing a partnership return, you're electing to be treated as a partnership. But yeah, if you're single, you need some sort of partner. You could do it with a trust also, but it would not, I don't think you could do it with a grantor trust. It would have to be an irrevocable trust.
yeah, we run into some issues with that.
so even if a single person had it in an LLC,
Yeah, they still need a partner to file a partnership. So, there's some way they would need to have another partner or, divest their ownership in that property to someone else or a separate entity. The grantor trust wouldn't be separate from them individually, because that's also a non-recognition for tax purposes. But an irrevocable trust or an S corporation would be the way to go. But you would definitely want to be making a lot more than $100,000 on your rental real estate if you went that route, because then you got 2 more tax returns to do.
Right.
And some other attorney fees and everything else to make up that difference.
Yeah.
But it still might be worth it for some, and especially for people that have commercial properties too.
I have a question
Yeah.
from Zoom
Yeah,
land.
go ahead. Yep.
What if a single person has multiple LLCs? Can the LLCs partner in that way?
No, I mean, a single
Well,
person with multiple LLCs.
Well, if they have partners in that LLC, any LLC, as long as there's more than one person, I mean, if the member is single, that's okay, as long as there's other people in their LLC,
Mhm.
as long as the LLC.
I don't think
files
that's what-
partnership
I don't
return.
think that's what's being said, though.
But if.
It's a bunch of single member LLCs is what you're saying.
Yes.
Yeah. Yeah.
Yeah,
no.
that would be the same thing, and you could do your combination. but you
Exactly,
still have to
yeah.
have another partner.
Yeah, you still need an additional partner. You can't say, I'm a single member, I have a single member LLC in Apple and also a single member LLC in Banana, and then combine the two. You need a separate partner. in there.
Okay, thank you.
Yeah, so just a reminder that if an ABE election was made in 2021 and the plan is to extend your 2022 partnership return, either 80% of 2022's ABE payment or 100% of 2021's ABE payment must be made by March 15, 2023 to have a valid Idaho extension. So what can we do for 2023? So as we mentioned earlier, planning is really the key to maximizing this workaround deduction. Ideally, only the rentals that are generating consistent net income should be included in ABE considerations. I mean, there'd be really no point in, planning to do this with a rental that's consistently throwing off losses, because then you would be you would have a lower ABE deduction. For multiple rentals held in separate LLCs, So say my wife and I own 4 different rental properties, but they're all held in their 4 separate LLCs. Instead of filing 4 separate partnership returns, what you can do is create a master LLC. And then you just quit claim all 4 of those LLCs that you own your rental properties in into the master LLC. And then the master LLC would file 1 partnership return. And of course, in that situation, we would only want to be contributing rental properties that are creating net income, because we wouldn't want to be throwing in and a rental property that has an $100,000 loss and thus reducing our potential ABE deduction. And yes, meet with a tax professional and attorney to aid you in proper tax planning and quit claiming of properties of the LLCs. This is very complex, especially filing these partnership returns. I would not recommend that anyone try to do that on their own. It's hard enough for us to try to get these things done. I can only imagine someone who's just trying to do that for fun. So here's a map showing the states that currently offer SALT workarounds, and this is from the AICPA, and it was updated as of January 10th, 2023. And this thing is changing, it seems like, all the time. You know, we went to a conference, I think it was a few months ago, and already several states have flipped. So just to give you an idea of where these SALT workarounds exist. Obviously, Washington, Texas, Florida don't have ABA deductions because they don't have state income tax. But even though all of these states, or most of these states, may be blue, a lot of these states have differences with their SALT workaround limitations. So for Idaho, the annual election must be made on a timely filed original return, so which we know, and the election is irrevocable, and overpayments may be refunded or carried forward. So I wanted to actually bring that up. So let's say during your tax planning for that for the year, you think, well, it looks like I'm probably going to have about $100,000 in net income. Let's make a $6,000 ABE payment. And then it turns out, well, I didn't have $100,000 in net income, I had less, right? That $6,000 overpayment, however much you overpaid, you can either have that overpayment rolled forward to next year, or you can just get a refund from the state. So California is a little bit different. So an annual election needs to be made when the tax return for the taxable year is filed, similar to Idaho. But the pass-through entity must make an initial payment by June 15th. So if you don't, Idaho doesn't require that you make estimated payments. I mean, it only requires that you make that safe harbor payment of 80% or 100%. California actually requires you to make an estimated payment. If you haven't made an estimated payment by June 15th, you can't be an affected business entity. You can't do this SALT workaround. So it's a situation where that tax planning is key again. You can't just go into it and, you know, come March 10th, think, oh, I'm just gonna make this California state payment. You didn't make an estimated payment, so you can't even be, you can't even take advantage of the workaround. And in California, actually, overpayments are carried forward. You don't have the option for refunds. So let's say that during tax planning, you way overshoot and you make way too big of a estimated payment. And it comes back and you overpaid by $10,000. Well, you have to have that $10,000 roll forward to next year. You don't get that cash as a refund. So
And
again,
also in California, you only have 5 years to use it or to keep it.
yeah.
So it just requires a little bit more planning and a little bit more accurate forecasting.
And I mentioned that Idaho, once you make the election, it's irrevocable. Oregon, for whatever reason, allows you to revoke your election, which again, I'm not sure why you would, because it's nothing but beneficial to you, but just something that Oregon throws in there just to be different, I suppose. Utah is exceptionally annoying. I had to deal with Utah a couple of times this year. So the election to be treated as an electing pass-through entity is made by electronically filing a SALT report, which is obnoxious, and submitting an electronic SALT tax payment on or before the last day of the PTE's taxable year. The salt tax and the salt report must be filed electronically and overpayments are carried forward just like California. So.
So this is what I spent New Year's.
Exactly.
Trying to get clients, that those filed for Utah, but.
And it was, Utah didn't allow this until 2022, so it was a new thing for everyone. I was working with someone else in the office and he was calling in to the state tax commission in Utah and they were just saying that they were overwhelmed with phone calls because no one understood how this is working. They didn't understand on their end how it worked and it's just a mess. In Arizona, partnerships and S corporations making the PTE election whose taxable income for the previous year exceeds 150,000 are required to make quarterly Arizona estimated tax payments. So similar to California, but you actually have to make quarterly estimated payments in Arizona if your net income in Arizona was high enough. So just a little taste. I mean, I know, if you're doing a lot of rentals in areas kind of close to Idaho, it's a little idea of the differences between Idaho. Idaho is very straightforward for the most part. Some of these states can be a little arduous. So again, I would highly recommend that you meet with a professional before you start trying to take this on your own.
Yeah, another comment on that too is Arizona, I mean, it's worth more in certain states, California has 90%, 9.3 is that percent, the holding rate on that, or payment rate on that. Idaho's a 6%, Arizona only has a 2.5
It's so low.
rate, so. Whether it's worth it to, do it maybe in Idaho and California, but Arizona, I'm not sure.
You
So-
said Idaho's is 6%.
Yes.
And they're actually talking about lowering it as well. Again, like
Again.
5 to 5
Yeah,
something.
Yeah, they've lowered it twice on that.
Mhm. Yeah, I'm sure people have been getting their rebate checks in the mail, and that's what those are for.
Nobody knows what they're coming, they're getting, so
Yeah,
just cash them.
Yeah.
Their ears.
yeah. So thank you, guys. I mean, it's a mouthful for me to try to, explain this stuff, and I appreciate you guys being patient.
And we will do a quick summary. So Arla, come on up. Stay up here.
Oh,
We're all
okay.
getting
hold on.
really close together. Yeah, no, nobody's home free. Okay, you know how I love my Tom, you know how I love my my highlight summaries. Okay. So here we have, wait, let's everybody step this way just so we can get into the screen. Okay, so here we have Aaron and Arla from BA Harris, and I'm Stacy McBain with Swope Investment Properties. And in learning about what's going on in taxes this year from our favorite tax accounting experts, what really stood out to me was a way to supercharge how many deductions you can make, which can end up saving you thousands of dollars on your taxes simply by using a workaround that Idaho has created. It's called
The SALT, which stands for the state and local taxes.
so we're getting around that assault on our deductions, which is otherwise limited to $10,000. But if we do what's the A stand for?
Affected business entity.
If we do the affected business entity election, we have to jump through some hoops, but we can in essence write off all of the taxes that we're paying to Idaho, and that tax rate is 6%. And if we don't do the ABE election, we basically are burning through that $10,000 deduction limit long before we ever get to being able to deduct our Idaho income taxes.
Yes.
Correct.
Yeah.
I don't have to give this presentation ever again. That's great. Work.
So what to do is you have to have your properties in an LLC. They can be lumped in one umbrella LLC, but talk to your attorney, make sure your liability comfort is there. Got to have an EIN. You've got to pay those taxes from your business account. And bonus points if you pay those taxes prior to the year end, because then you get your deduction sooner. If you're filing an extension, you got to pay some taxes with that, because if you don't give them enough money when you file that extension,
Extension's no good. Yeah.
and this could and likely would cost you more in accounting fees. And these guys, they're like, we'll help you, we'll take your business, but we don't need more of your business just to get your business. So they're not gonna tell you to do something just to make more money. So they have
Right.
said, make sure, what I liked, favorite quote, do you remember what it was?
Make sure the juice is worth the squeeze.
Make sure the
Yeah.
juice is worth the squeeze, people. That was brilliant. And because you're gonna go up in your tax fees.
Yeah.
And also, by the way, oddly, we all only worked the second half of 2022 and we did all of our driving then. We did zero driving in the first half of 2022 because of about a couple cent difference in miles. So when you are filing your taxes, actually make sure you tell your accountant, they're gonna ask you when you drove and racked up all those miles to the rental property, to the bank, to the Home Depot and back. And so you're gonna have to tell them when those happened. You still get to write off all of those business meal expenses and none of those entertainment expenses, but we're back to 50% meals in 2023,
Correct.
right?
Hey, I
Very
feel
good.
very good about that. That was awesome. I was like, no one's gonna get this. I feel great about that.
All right, well, thank you, avid investors.
Yeah.
Thank you, Eric and Tom from BA Harris. That's a wrap. Any last minute questions online or from in the room? Otherwise, we'll just hang out, network, drink the free beer you're all missing online. You gotta come back to the meetings. Thank you.
Thank you very much. Appreciate it.
Feedback forms, guys. Feel free to send Leslie a chat online and let her know what you thought of the meeting. Folks in the room, really need every one of you to fill out a feedback form if you don't mind. Half of us are online today.
Better, we're excellent.
Good to see you, Rick.
Hey, Stacy.
Thanks, Matthew. Thanks, Shannon. Thanks, Linda. And Brian, good to see you, Brian. And Bobby, if you're still here. Bye, guys. Thank you.